Welcome everyone. Thanks for joining our 90-minute webinar designed to prepare you for the accounting and audit issues you're likely to face with fiscal year 2020. We have a panel of 5 experts from REDW's National Tribal Practice on the line to share some helpful guidance. But before they get started, let me just first cover a few housekeeping items. If you have questions during this session, just click on the Q&A icon at the bottom of your screen. It'll open a window where you can type those in. Our speakers are going to wait until the end to answer them all at once. If we run out of time, we will provide a supplemental Q&A document, so don't hesitate to ask whatever questions you would like. We're also offering 1.5 CPE credits for those attending this live session. So to meet the requirements, you'll need to answer all 5 polling questions that will appear throughout the session. Then at the end, an online CPE request form is going to pop up on your screen. Just fill that out and hit submit. The presentation is being recorded. Access to the recording and a copy of the slides and other resource materials will be provided to you by email at about this time tomorrow. Well, we have lots to cover today, so I'm going to let Corinne Wilson, one of the co-leaders of our National Tribal Practice, start us off. Take it away, Corinne.
Hello to all you good people. I'm Corinne Wilson, principal in our Phoenix office and a member of the Fort McDermott Paiute Shoshone tribe. Also, I'm the co-leader of our firm's National Tribal Practice. I am very proud to introduce my colleagues today and your REDW presenters. Each of them are Native Americans and accounting and audit professionals. We recognize that this past year has created operational changes to all of our clients and tribes, and we wanted to provide you an overview of the key items that you should know as you're preparing for your audits and doing your accounting this year. Today, we'll be covering this year's applicable GASB updates that you need to be prepared for, the updated OMB Compliance Supplement and Addendum for 2020 audits, other CARES Act accounting and audit considerations, an update of the changes to the OMB Uniform Guidance, and also an overview of the CARES Act provider relief funds. At REDW, we are here for you, so be sure to ask questions if you have them during or at the end of our presentation, and we will cover as many of those as we can today. And then we will post any that we don't get to, and with our answers, with our materials, so that you have those. If at any time you have other questions after today, make sure to reach out to one of us. We're happy to respond. Now let me introduce our first presenter today, my colleague Wes Benally, who's our National Tribal Practice co-leader and your first presenter. Take it away, Wes.
Thank you, Corinne. Good morning, everybody. We appreciate the opportunity for coming to you today. My name is Wes Benally, as Corinne mentioned. I'm a senior manager in the Phoenix office, and I'm Dene, originally from northern New Mexico. And we appreciate being here today and welcome you, whether or not you're from your home, your office, or in your closet hiding from your kids to listen to us. We appreciate it. So our learning objectives today are to go through the GASB updates. One is to identify the effective dates for new GASBs and when they will apply to your organization, and obtain an understanding of key provisions and technical bulletins of applicable GASB pronouncements for 2020 and 2021. And more importantly, how they may apply to your tribal organization. And before we start, I'd like to start with a polling question. First off, are you aware of and prepared for the GASB standards you need to implement for your 2020 and 21 audits? So we're gonna get started here. Okay.
Remember, you do want to answer this question if you're looking for CPE credit. Thanks. I think our answers have slowed. I'm going to end the poll and share the results.
Okay, 55%, not sure. Great. Well, glad you joined us today. So hopefully we can provide some updates and hopefully scare you into going and moving forward with this, because there's a lot to do and there's a lot to review and research as you move along understanding the GASBs. So this slide here depicts the overall timeline for important GASB standards that tribes will need to consider based on the beginning of the fiscal years. For those tribes with September 30 year ends, we added within the slides the effective dates, since the GASB tend to schedule the GASB implementation dates around state and local governments. As such, it would be important to you to ensure that you communicate with your finance and accounting teams and auditors to prepare for these items. As you will notice that as we move from left to right, the timelines, the GASB pronouncements are not in chronological order. For example, GASB 87 is now for beginning fiscal years after June 15, 2021. So those are some things to consider. Now let's get started. Now we start with those beginning after December 15, 2019. GASB 84, fiduciary activities. Now this is a big one. What this does is defines specific criteria to identify activities for state, local governments, and tribes and their entities, including those engaged in business activities. It defines what should be reported as fiduciary activities and how government should report fiduciary activities in their general purpose external financial reports. Tribes need to reassess their fiduciary funds and pension funds as there could be changes. So kind of taking a thought back of this is fiduciary funds are used to account for an entity's assets held by an entity in a trustee capacity for individuals, private organizations, and other governmental units. Well, generally, they're reported using the economic resources method and the full accrual basis of accounting. The thing you want to consider is now that there are 4 types of fiduciary funds: a pension fund, an investment fund, a private purpose, and now a custodial fund. For today's discussion purposes, we're only going to focus on the pensions, as those are, highly involved with the fiduciary activities now. So pension plans and OPEB, or in this case, other post-employment benefit plans, are those that are administered through trusts and that meet the criteria of paragraph 3 of GASB 67 and 74. Other employment benefit plans for which resources are held in a trust that meet the criteria of paragraph 111C and 2, and they make contributions to trust, and earnings on those contributions are irrevocable. So those are some things to consider. Now in this next slide, like myself, I tend to understand things more in a visual display. And this is my attempt at trying to show this as much as possible. As you can see there at the left, using the same conceptual guidance from GASB 14, we need to determine if an entity is a legally separate organization and if there is a voting majority, fiscal dependency, and financial benefit burden, or a financial burden or imposition of will. And then from that point, we can determine whether or not it's a component unit. At the right is an attempt to show the relationship between the fiduciary fund and how that will be reported within the overall government-wide report. A few questions to ask, is it a legally separate entity? Examples include 401ks or some trusts. Those are typically set up as legally separate entity. Another thing to kind of think about specifically for tribes or mini per capita or minors trust funds are not. And we'll go through a quick example on that here in the next couple of slides. Other things to consider: voting majority. One question to ask yourself is, does the tribe have continuing appointment authority, and can the tribe unilaterally abolish the plan? Another thing to consider is financial benefit and burden. If the tribe has historically made contributions to the plan, there is an assumption of an obligation to the plan. So those are some things to consider. Now, with respect to GASB 84, this is probably one of the most important decision model trees to consider when going through and reading the GASB and implementing it for your tribe. So previously we talked about are the assets held by a component unit. So your first determination would be whether or not the entity is legally separate and doesn't meet one of the criteria, therefore becoming a component unit. So from this standpoint, you need to determine yes or no. And then from that point, you need to ask the question, are the assets held for a pension or an OPEB arrangement? Now, based on the series of fact patterns and what you have, you fall in one of 4 buckets. And we'll go through here in the next slide, buckets 1 and 2, which basically indicate that it's a component unit, but whether or not it's a pension or an OPEB plan, we can talk about that. So door number 1, we'll call it. This is when it's a component unit and control is not in question. So basically indicating that under number 1 is probably the easiest, is that the contributions, first off, excuse me, this plan is a post-employment benefit plan or it's a pension plan. So the things to consider are the contributions to the plan are irrevocable. The second thing to consider, the plan assets are dedicated to providing benefits. And the third thing is that plan assets are legally protected from creditors. If you fall in this category, then you have fiduciary activities. So these are some things to consider. Now we go under door number 2. If you determine that there is a component unit, but then this legally separate entity is not a pension agreement or an OPEB agreement, it is a fiduciary activity if the assets associated with this activity have one or more of these characteristics. Now, the assets are administered through a trust or equivalent arrangement. The assets are dedicated to providing benefits to recipients in accordance with benefit terms, and the assets are legally protected from the government's creditors, and the assets are for the benefit of organizations and other governments that are not a part of the financial reporting entity. So if you go through and analyze this and you come across that, then you probably have a fiduciary activity. Now we go to the other side. What if you determine it's not a component unit? Then you have to take a look at the control criteria. We'll look at door number 3. This door contains when you have a retirement or post-employment benefit. However, you determine that it's not a component unit though. So things to consider. The government controls the assets of the arrangement and contains the following. And if it's administered through a trust. So those are some things to consider. And in a circumstance which assets from entities are not a part of the financial reporting entity and are accumulated for pensions. So really, you got to take a step back and just think about, okay, it's a pension, but it's not a component unit, but does it have the same characteristics? Therefore, it's most likely a fiduciary activity. Now we go to door number 4. This is for all other fiduciary activity. This is when it's not a component unit and it's not a post-employment benefit. That is not a pension arrangement or an OPEB arrangement. And is a fiduciary activity if the assets are associated, have one or more of these characteristics. Number 1, control. Keep kind of going back to this control. The government controls the assets. The assets are not derived from the government's own resources. For example, taxes and so forth. From government mandated non-exchange transactions or voluntary non-exchange transactions. So, for instance, pass-through grants from governments and then once again back to taxes. And the assets are administered through a trust agreement or equivalent. So you got to read the trust agreement, read those agreements that they have, and whether or not it's equivalent, then those are some things to think about. And lastly, once again, the assets within this entity are for the benefit of individuals, and the government does not have administrative involvement. If you meet those criteria, then you most likely have a fiduciary activity. Now we have a quick example. This is for per capita minor trust funds. Now, a tribe has a minor trust fund for their minors 18 years and younger that is currently reported in the tribe's financial statements as a fiduciary fund. In addition, based on the tribe's revenue allocation plan, gaming profits require contribution on a yearly basis. In a review of trust documents, the tribe can revoke and take control of the assets. Should the tribe include the activity for this trust fund as a fiduciary fund? Yes or no? Well, in this case, this is kind of a tricky question because if the tribe set this up as an irrevocable trust, then the tribe can continue to report as a fiduciary fund. However, if they didn't set up as a revocable trust, then this would be considered as a special revenue fund of the government. So it's important to kind of go through these steps and think about this when reevaluating your trust agreements and other agreements in accordance with GASB 84. Now we move on to the next item, which is for fiscal year beginning after December 15, 2019. Majority equity interest and amendment of GASB statements number 14 and 61. So what this basically does is help governments determine whether or not they have an investment or a component unit. So GASB 90 clarifies that a government with a majority equity interest in an organization that remains legally separate after acquisition must report its equity interests as an investment. If it meets GASB's investment definition, then it would be measured using the equity method. For majority equity interest in a legally separate entity that does not meet the definition of an investment, the government is to report the legally separate entity as a component unit. Went to this next slide. So this is an example straight from the GASB codification. So the real thing to consider here if you do come across a transaction like this is the intent. The intent for criteria for distinguishing an investment from a component unit. In that example, a government purchases 100% of stock of a concrete plant. So let's assume that a government does that. Now, kind of taking a look at the intent. If the government's intent is in owning the concrete plant is to provide a controlled source of concrete for its capital projects, and here it would service the government, then it would be reported as a component unit. However, if the intent for owning a concrete plant is to earn income or profit, and the present service capacity of the equity interest is based solely on its ability to generate cash or to be sold to generate cash, then the equity interest meets the definition of an investment. So when dealing with this GASB, you need to think about the intent. What's the intent of this transaction, and what's the intent of the investment? Now we move on to those GASBs beginning after fiscal year December 15, 2019. GASB 97, certain component unit criteria and accounting and financial reporting for Internal Revenue Code Section 457 deferred compensation plans. That was a mouthful. And kind of going back to this is kind of a complex area. So with GASB 84 and GASB 97, they're both intertwined with each other. And I'm just kind of touching the surface with these, and there's a lot of professional judgment involved in this. But with GASB 97, it has various effective dates, and beware of that as you move along and analyze any activity you have that apply to this. What it basically does is just put limitations on the application of financial burden criterion for contributions to a post-employment benefit plan. So only post-employment pension and defined benefit and other post-employment benefit plans. So basically all that really means is that you now have to think about a post-employment benefit plan versus a post-employment contribution plan. And we can talk about that here in a little bit. Basically the GASB thought that, reducing the amount of evaluation to post-employment benefit plans would reduce costs. However, you need to analyze that in your evaluation of this. We move on to Section 457 plans. Now, GASB 97 also addresses Section 457 plans, really because prior to Statement 97, Statement 32 was developed for tax code changes that required assets of 457 plans to be held in trust for the exclusive benefit of participants and their beneficiaries. So when 84 was implemented, there was a lot of questions regarding 457 plans because, over time, as tax laws changed, these 457 plans kind of morphed into pension plans. And as you can see, as I read, the definition of those plans really kind of fell in line with pension plans. So what GASB 97 states is that if a Section 457 plan meets the definition of paragraph 3 of GASB 67 and 74, which deals specifically with pension plans and other post-employment benefit plans, then it would be considered a pension plan. So therefore, the management team would need to apply the criteria we talked about in GASB 84 to go through and determine whether or not that 457 plan is a component unit, and then go through the process evaluating whether or not it's a fiduciary activity. Otherwise, the 457 plan could be considered an OPEB plan, other post-employment benefit plan. So those are basically the distinctions it makes. And really what you get out of GASB 97 with this is that you really go through and evaluate the contribution sides of things as opposed to the pension plan benefit side of things. Now move on to, for those beginning after fiscal year June 15th, 2020. GASB 93, replacement of interbank offer rates. So this came about because of the London interbank offer rate scandal. I think it happened back in 2012. And this also applies to hedging. And if you have any, maybe interest rate swap obligations on any of your debt, if there's anything like that you have, then you would need to pay attention to this. In addition to this applies to all kinds of debt that tribes have. As you have in your contract, usually there's a reference rate to LIBOR. So beginning December of 2021, that no longer is going to exist. And so, what that's going to do then is require governments, tribes, and so forth to consider using a different rate. Obviously, and then the government's provided several rates to consider. Now, how this kind of provides a little bit of headache is that within GASB 53 for derivatives, if you change your reference rate, then ideally you need to terminate your hedge or terminate your interest rate or the interest rate swap that you use. However, the GASB provided some relief on this. So what they basically done, the GASB, is that they provided a two-step process. And they allowed most tribes to go through and use, several different rate factors. One of them is the interest rate on direct Treasury obligations, the effective federal funds rate, and a secured overnight financing rate, as they are classified as risk-free. Now, when we talk about going from LIBOR to SOFR, which is a secured overnight financing rate, to smooth the transition, the GASB recommend the following. It's a two-step process. First, amend or replace a hedging derivative instrument to change to an IBOR, which is interbank offer rate, to a new other rate. So this sometimes what happens is within your contracts that you have, if you're doing derivatives, there'll be another interest rate within the contract that is referenced in the instance that a LIBOR is not used. Now, if that's not mentioned within the contract, then one of those three rates I mentioned before can be used. Now, the second step of this in this transition is that once you determine a specific rate that's allowable, then you'll transfer over to this SOFR rate. So that's the transition process they allowed. Now, the thing to consider with this as well, and how this plays into future GASBs, is within GASB 87, which we'll talk about here soon, leases, the discount rate sometimes incorporates the LIBOR. So when you're going through and reevaluating leases and calculating discount rates and so forth, you can substitute those LIBOR rates for a SOFR rate or one of these other rates that have been mentioned in the GASB here. So those are things to consider. Now we move on to those GASBs that begin after fiscal year December 15th, 2020. In this case, GASB 89, accounting for interest costs incurred before the end of a construction period. This really is to enhance the relevance and comparability of information about capital assets and the cost of borrowing for a reporting period, and to simplify accounting for interest costs incurred before the end of a construction period. So this really applies to business type activities and to provide uniformity between them. So basically, all this indicates is that interest cost incurred before the end of construction period will now be expensed rather than included in the historical cost, capitalization cost of a capital asset reported in a business type activity or an enterprise fund. So, obviously this is going to have some big impacts on your income statements, especially for possibly those casinos that are involved with a lot of construction activity. You really need to go back and evaluate the interest impact on your financial statements. Now we move on to those fiscal periods beginning after June 15th, 2021. So that's coming up here. And I think the biggest one here is leases. A lot of us have brought this up, and previously, however, through GASB 95, there was a postponement in the implementation of this. However, we highly recommend that you go through now and begin to analyze this, because it can be a tedious process. Now, under current guidance, what it says is that operating leases are reported without a liability from a 500-foot level view. Now, what's going to happen is that those operating leases, based on your evaluation, may have a substantial impact on your balance sheet. The new lease treatment will also include a lease liability and a right to use asset. And the rent expense will be replaced by interest and amortizing on the lease intangible lease. The leasee will recognize interest on the asset and the liability and amortized over the life of the asset. Leasees will present a new intangible right to use lease asset as a capital asset and a lease liability for future payments. So those are some big things there. From the leaser standpoint, if a government is required to recognize a lease receivable and a deferred inflow of resources at the lease terms beginning, lease revenue then will be systematically recognized over the lease term with a corresponding reduction in deferred inflow of resources. So there's a lot of new terms that come about this new GASB, and therefore, you got to make sure that you understand those terms. Now, just some big areas to consider. Really one of the big things is, the definition, what does that mean? Control and lease term, because as those will help determine the amount and the time in which, you capitalize or recognize a lease. So just to provide a definition of a lease is a contract that conveys the control of the right to use of another entity's non-financial asset, as specified in the contract for a specific period of time. So one of the biggest thing is just a contract. This is a legally binding hook. So that's one thing to think about. And then control. Now we move on to control. The notion of control in the lease definition is applied to the contract's specified right to use asset. A leasee has obtained control of the right to use asset if the contract conveys the leasee both the right to determine the underlying asset's nature and the manner of use and obtain the underlying asset's present service capacity. So you have to have a specific asset which you're leasing. Now the lease term. And we'll go through that here in the next slide, as that has a little bit of we have a couple of exceptions to that, excuse me. When thinking about a lease term, you want to think about three main items. Whether or not you have a non-cancelable period, and then this can be adjusted for periods covered by the leasee or lessor with the options to extend or terminate the lease. If it's reasonably certain, options to extend will be exercised. Now, options to extend or cancel. These are periods for which the leasee and lessor have each an option to cancel the lease without the permission from the other party, or if both parties must agree to extend. Those are cancelable leases excluded from the lease term. The presence of cancellation penalties does not affect this conclusion. So those are things to consider when thinking about the lease term. Now we move to intra-entity leases. Between government and enterprise contracts, sometimes you want to consider this because, there are instances when a government and an enterprise fund don't have written contracts between each other. So you need to go back and make sure that there are some written contracts, maybe update them just to ensure that those are there. Ideally, what this entails is that if you have an enterprise fund and a government and they have a lease agreement between each other, the netting effect, is still in play. However, if a standalone entity, enterprise fund, presents its financial statements, they need to show the lease and the asset on their books, or vice versa. Now, if it's a discretely presented component unit, then it would show its lease asset or its liability, or vice versa. So those are some things to consider. Now, here's a quick example just to kind of get your brain going on when you go back to the office or when you go back and think about leases. Let's just have a quick scenario here. They tried to lease a building to a utility authority. There's a non-cancelable term of 10 years, and the fixed payments are $15,000 and are due at the beginning of each year. At the end of the fiscal year, the utility authority is entitled to a rebate of $5,000. This is considered an incentive. There's a 3-year extension likely to renew, and the discount rate is 6%. So the lease term, one thing to consider is it reasonably certain that, the 3-year extension will be used. So that's something you need to consider because that could change your non-cancelable term from 10 to 13, but that's something you need to consider. And then the discount rate, what you need to consider here is, the use of LIBOR, if that's going to be in use for you moving forward December 31st, 2021, and moving that and then using that discount rate based on another rate used. So those are some things to consider. So there's a lot of intricacies in just kind of looking at fact patterns within your leases and the relationship between a government and its entities. Just some implementation suggestions to be worried about. This may impact some of your debt limits and debt covenants. So, you may evaluate some of these leases and they may generate greater than 1 year. If you have a specific ratio that, you measure your debt covenants on, this could change that, especially if you're adding new debt onto the balance sheet. Most importantly, probably is your lease policies. Have you gone through and actually looked at them to change them? Because that could be a big effect. And are you communicating with your current finance and procurement teams to ensure that when they enter into new agreements with vendors, are they evaluating those leases on the old standards, or are they evaluating those leases on the new standards? And then lastly, your capital asset policies. As I mentioned before, there's going to be a new category called right to use. So you got to ensure that your policies and procedures include those terms, and that everyone down the chain understands and knows those terms. Now, lastly, the GASB technical bulletin. So this GASB Technical Bulletin covers a couple things with respect to CARES Act. Now, I'm not going to go into detail with respect to lost revenues and operating versus non-operating because our friend Mr. Marcus Spinelli is going to cover that stuff in the provider relief funds here soon, the next couple of slides. Now I'm going to follow up on the eligibility versus purpose restrictions. Now, what this basically indicates is that a recipient government should recognize resources received as a liability until eligibility requirements are met. So in this case, a deferred revenue. So you recorded deferred revenue for these liabilities until they're spent. Subsequent events. So the subsequent events item here talks about, let's just say you have a fiscal year in, and then you haven't finished completing the audit, but there's an amendment to the CARES Act. You don't need to take into account the amendment to the CARES Act for that specific audit report. It would occur in the year that it happens. So that's one clarification I made. You may want to consider disclosing it, but you don't necessarily need to do a recognized event. PPP loans. Now, a lot of enterprises receive PPP loans. One of the key kickers in this is that if they haven't received legal release from the debt from the bank, then at year end, that loan should be reported as a loan on its book. Now, there's different interpretations on how the loan should be presented, but there should be a liability on the books for that specific PPP loan. And then now, last, infrequent items. There are questions regarding infrequent or special items. What's been recommended is that they're not infrequent and they're not special items or extraordinary, is because coronavirus will be around for a while and it's not going to change. It's not a one-time event, if you will. So the GASB's recommended that we wouldn't present those in the financial statements as such. So now I'm going to turn it over to Mr. Mike Dearlum, and he's going to go over the 2020 Compliance Supplement and the Addendum.
Thank you so much, Wes. I appreciate that. My name is Mike Dearlum. I'm an audit senior manager in our Phoenix office. I'm a member of the Cherokee tribe, and I've been working with tribal governments and tribal enterprises throughout my public accounting career, and it's my privilege to talk to you today about the 2020 Compliance Supplement and the associated addendum. So get into that. All right, the 2020 Compliance Supplement, what we'll talk about is we'll give a little bit of background on the 2020 supplements and the addendum, specifically how they can be used by tribal governments. We'll talk about key updates to the 2020 supplement along with the important material found in the addendum. And we'll also make sure we touch upon sort of throughout my slides here, some of the need to know information in relation to the compliance supplement for COVID-19 and CARES Act and those single audit implications. So first off, just a little background on the 2020 compliance supplement. The initial supplement was released to the public in August of 2020. And at the time, it was stated that there would be an addendum related to the CARES Act information. So, that initial supplement was not all inclusive and there was an expectation of an addendum. The addendum was then released in December. And these supplements are applicable for audits beginning, audits of fiscal years beginning after June 30, 2019. So for most tribes, we're talking about your year-end September 30, 2020 and December 31, 2020 audits. Both the supplement and the addendum are publicly available at the website here. And of course, these slides will be available if you need this link. Quick polling question here. Does your organization review the annual compliance supplement as part of your analysis of federal grant compliance? And I believe Carla is going to launch that poll for us. There we go. All right, we've got some answers coming in.
Remember, if you want to earn CPE credit, be sure to answer this question.
Thanks, Carla. No right or wrong answer on this, of course, just trying to gauge how we're using the compliance supplement.
Okay, I think the answers have slowed. I'm going to end the poll and share the results.
All right, fantastic. So hopefully everyone can see that. Looks like approximately half of us utilize the compliance supplement. The other half are no or not sure. But we'll go ahead and talk a little bit about the compliance supplement. So understand the compliance supplement, which is released annually. It was created for both auditors and auditees. And its primary function is to communicate those critical compliance attributes for federal awards by CFDA number. So you can look up a specific grant, a specific CFDA number, and utilize that because it's going to communicate the key compliance attributes and also internal control standards for compliance. Some of the helpful uses, if you're wondering why do I need to, in a practical sense, why do I need to maybe look this up and compare it against what we're doing internally, it'll help you become familiar with the applicable compliance attributes for your federal awards. It's a great tool, especially for your larger grants, those ones that are maybe commonly selected as major programs by your auditors, a really good tool. And it'll also assist you in preparing your supporting documentation for auditors in advance of the single audit. You'll kind of get a sense of, okay, these are the compliance areas that the auditors are likely to look at. It's really used as an auditor guide, so you can kind of see in advance what they're going to be asking for and looking at. It can also guide any of your internal reviews of program compliance and your controls. And you always want to keep in mind that grant agreements directly with the grantor always do take precedence. And really that compliance supplement is sort of a, appendage, in addition to your grant agreements. All right, some compliance supplement updates and a couple things related to the CARES Act here. The CARES Act has provided additional funds to many existing CFDA numbers. So your recurring programs, many of those may have received additional funding through the CARES Act, supplemental to your typical annual funding. And the compliance supplement actually stated that the majority of federal agencies have received additional funds under the CARES Act. One thing we wanted to point out is that supplemental CARES Act funding should be tracked and presented separately on your schedule of expenditures of federal awards or your CFA. So your tracking of these of the spending should be separate and distinct between the typical ordinary programmatic funding and the supplemental funding from the CARES Act. They'll likely have the same CFDA number, but they'll need a separate line on the CFA. And of course, all that needs to be tracked internally. Additionally, due to additional funds received under CARES Act, many tribal governments may have provided resources to their enterprises, departments, and component units. Of course, we're seeing a lot of this, across Indian country. It's important to consider the potential single audit implications of allocating CARES Act funds to other tribal departments. And in instances where this is occurring, it's critical that tribes document the approach they're utilizing to fund those related parties. That can be, as an example, listed here, maybe as under the terms of a small business grant, where the recipient is a beneficiary. Could be a type of inter-fund reimbursement where the government is reimbursing specific allowable costs of another fund. Or it could be under the terms of a traditional sub-recipient agreement where it's a sub-award. And it's really key that tribal governments make that and document that approach and the outcome, and that will assist in verifying whether or not a single audit is required by that other entity that received funds. An example would be a tribal water department that received $800,000 to make water system improvements. A single audit may be required in situations like that where, in instances where the programmatic decision-making is truly being passed down to that tribal water department. There's kind of a lot of factors to consider, but this is just kind of a reminder that those determinations should be made prior to your audit starting, and really critical to have all the information in place. Additionally, this is regarding the Federal Funding Accountability and Transparency Act. I'm going to say FFATA for short, but most CFDAs require audit tests of reporting, and many use FFATA. For fiscal year ending September 30, 2020 audits, auditors are required to test FFATA reporting only for COVID programs listed in the addendum, with the exception of the CRF program, Coronavirus Relief Fund program. And for fiscal year December 31, 2020 audits, it's likely that FFATA reporting may be applicable for all programs. Our note at the bottom there, tribes should monitor the terms and conditions of your award to see if any of this applicable reporting is required by your grant. Some of the specifics of this type of reporting: it requires reporting of subawards of $25,000 or more, which includes subrecipients. It also requires reporting of subcontracts of $25,000 or more. Additionally, it requires monthly reporting in the FFATA subaward reporting system. So it's kind of a whole new branch of reporting that we need to get familiar with, and it's very likely if your tribe administers a large number of grants that some may be required to do this type of reporting. So need to start becoming more aware and knowledgeable about it. CRF Treasury clarification for tribal enterprises. So there was communication between NFOA and the Treasury. We have this as a handout, and subsequent to this presentation, there'll be an email that goes out that will have these handouts and a link to the recorded version of this webinar. But so we'll have that as a handout. It does clarify audits of CRF funds that support tribal enterprises or entities, and gave some clarification for when a tribal enterprise receiving funds may or may not be subject to a single audit itself. So some of the key facts and clarifications they made: number one, were that for-profit subrecipients are not subject to single or program-specific audits, and that's straight out of the uniform guidance there, the reference there. Tribal enterprises that are not separately incorporated and received payments for costs of reopening or covering operational expenses would be a beneficiary and not subject to single audit. So, the Treasury clarified, instances of a tribal enterprise being a beneficiary of this funding, as opposed to a recipient or a subrecipient of federal awards. And then finally, a tribal structured nonprofit entity that has not been separately incorporated and considered an arm of the tribe, which has greater than $750,000 of CRF or federal funds, would be subject, would be a subrecipient and subject to single audits. Finally, at the bottom there, tribes are responsible to ensure subrecipients and beneficiaries provide necessary reporting and records to support the use of the CRF payments. All right, specific compliance supplement updates. So this was in the initial compliance supplement. Again, it came out over the summer. It communicated that existing programs may have compliance requirement changes due to COVID-19 and other reasons. It's very, clear that, there was, not complete information in the initial compliance supplement, especially as it relates to COVID-19, CARES Act, and related federal funding. Appendix 7 expanded to include the initial COVID-19 guidance. So you'll see the initial COVID-19 guidance there. And then also Section 3.1 was removed. This is kind of a landmark a little bit, but this section previously was included in compliance supplements as it referenced and talked about the transition to uniform guidance from the prior standards. That's been removed, and OMB considers the transition complete. There's no more A133. There's no references to the old, the old guidance. It's now all just the uniform guidance, and that's what we're on now. As it relates to the compliance supplement, Appendix 5 is your roadmap to changes found within the new supplement. They did retain the 6 compliance requirement for each CFDA mandate. That's been continued. What that dealt with was it gave a maximum number of compliance attributes that could be considered subject to audit. And so for federal agencies, they had to decide what those 6 critical compliance attributes they wanted tested by auditors were. The one exception is some R&D clusters can have 7. And it's important also too to state that activities allowed and allowable cost related principles, they do count as one requirement. Now, some agencies may have made changes to their compliance attributes that they've determined to be subject to audit, but you'll have to review part 2 of the matrix to verify whether your program has changed or stayed the same. There are new programs found in the compliance supplement. If you're not aware, not every federal program, not every CFDA number can be found in the compliance supplement, although many are. Some new programs that have been added to the compliance supplement for 2020 include the Housing Trust Fund, Crime Victim Assistance Grant Program, Equitable Sharing Program, and Ending the HIV Epidemic, A Plan for America. There have also been changes to a variety of programs in the compliance supplement. Some include Head Start, CHIP, and the Economic Development Cluster. Also, cross-cutting sections have been updated. The cross-cutting sections cover compliance attribute compliance for a variety of CFDA numbers all in one batch section of the compliance supplement to avoid repeating the same things over and over again for a number of programs. So that's been updated. You'll want to make sure you have that along with your program's compliance supplement if it uses a cross-cutting section. Also, verify your CFDA numbers each year. Sometimes they change, so verify your CFDA numbers is great advice. Another polling question here, CARES Act funding awarded to tribes, which is passed to the tribes related parties, may result in new subrecipient relationships, and these relationships should be evaluated by the tribe prior to the commencement of the audit. If you want to go ahead and give your answer there. All right, lots of answers pouring in. Thank you for answering the poll. Looks like we're slowing down. Carla, if you want to end that polling. All right, there are results, and great. We had great answers here. 94 said true, and that's accurate. Tribes must have determined if awarding funds to a tribal entity results in a subrecipient relationship. Again, if it's a subrecipient relationship as is defined by the uniform guidance, that entity would be potentially subject to a single audit, and the tribe would need to perform subrecipient monitoring. You can find more information about subrecipient determinations and that definition at the reference there within the uniform guidance. All right, now the December Addendum, which of course had a lot of really critical updates, had a lot of information on the programs you see here. First off, the PPP loan in the top left there, it does have a CFDA number. It is not in the compliance supplement, and that is because it is not subject to single audit. So that's great if you're worried about that. PPP loans are not subject to single audit. We have provider relief funds to the right of that. Again, we have a section of this presentation dedicated to that coming up here shortly. The Coronavirus Relief Fund, of course, was instrumental to tribes for 2020 and into the 2021 calendar year. It does have a CFDA number, 21019, and the Education Stabilization Fund makes up a large portion of the CARES Act. The big one, I think, for us here today is the CRF program, Coronavirus Relief Fund, applicable for so many tribal governments. And per the matrix that came out, it listed the following attributes as applicable and subject to audit. Remember, this is not all of the compliance requirements for the CRF program. This is just what the auditors are being told is subject to audit as it relates to the single audit. So, of course, activities allowed or unallowed and allowable costs and cost principles is applicable. Specifically in the compliance supplement, it states that auditors need to use the Treasury guidance and FAQs as criteria for determining compliance with this attribute. The period of performance is subject to audit, and primarily auditors are going to be looking at whether or not expenditures were incurred after that March 1, 2020 start date that we've all heard so many times. Reporting is applicable, and that includes the quarterly financial progress reports submitted on the Grant Solutions portal. So just be prepared to provide that to your auditors. Finally, sub-recipient monitoring, as we talked about, is applicable. And again, our reference in uniform guidance is there. As it relates to the CRF program, allowable activities and costs have the following primary criteria. And maybe you've heard these has been pretty repeated throughout this, I guess ever since the CARES Act and CRF program was launched, but they have to be necessary expenditures incurred due to the public health emergency with respect to COVID-19. They have to have not been accounted for in the most recently approved budget as of March 27th and incurred during the period that begins March 1, 2020. I think the important part is some of the necessary expenditures, and that larger bullet point there, governments are responsible for making determinations as to what expenditures are necessary due to the public health emergency with respect to COVID-19. Now, necessary and compliant are different things, so you still have to follow the Treasury guidance and the FAQs, but the necessity of an expenditure, that's determined by tribal governments. Treasury has updated and published its federal regulations in Federal Register, and that also will be a handout that comes after this presentation. CRF compliance, some examples of allowable costs. I'll go through a couple of these, but of course, medical testing and facilities, the second bullet point, public health, PPE, safety measures, et cetera. Payroll for public safety or public health. And at the bottom there, economic support for grants to small businesses or payroll support, unemployment insurance. These are all listed specifically as allowable costs in the compliance supplement. Some that are explicitly stated as not allowable, replacement of lost revenue, payroll or benefits to employees whose work duties are not substantially dedicated to mitigating or responding to COVID-19. Down below, severance pay or legal settlements. Also, damages covered by insurance is not an allowable cost as it relates to CRF. Our last polling question here for my section, tribal governments should use the Treasury FAQs to determine which expenditures are necessary to respond to COVID-19 and the public health crisis. A little bit of a trick question, forewarning here. Who determines which expenditures are necessary to respond to COVID-19 and the public health crisis?
I think that was a good clue, Mike. People were changing their answers.
I'm watching the live results. Suddenly things change real quick. Yeah. All right, we'll do a couple more seconds. You can get your answers in. All right, we'll go ahead and end that poll. All right, so as you can see, pretty even split here. And as Carla mentioned, I mentioned it's a little bit of a trick question, but the answer is false. Again, tribal governments make the determination of what is a necessary expenditure as a response to COVID-19. However, tribal governments, of course, have to use the Treasury's initial requirements, the FAQs, the Federal Register to ensure compliance. And the timing and approval of justification is key. FAQs were coming out after these funds were released. And so understanding the timing of when something was approved by your government and the available FAQs at the time may be key to support your evaluation of compliance. Last couple of things. This relates to the extension to single audit due dates. That's in Appendix 7. Original single audit due dates that were given a 3-month extension. So if your original due date was October 1, 2020 through June 30, 2021, you've been provided a 3-month extension. So if you're a 9/30, your 9/30/2020 audit is due 9/30/2021. That's just for entities that received CARES Act funding and they can still be considered a low-risk auditee. Some other minor miscellaneous notes regarding receipt of donated PPE, purchase with federal assistance. These should be included on the CFA as a standalone footnote in the CFA at their fair market value and marked as unaudited. A little unique, but if that applies to you, that's important to disclose that. There's a new cluster program, the Federal Motor Carrier Safety Assistance Cluster. And finally, the Indian Community Development Block Grant has a new special test added, which you'll want to make sure you look into prior to your audit starting. I know we went through that quick, but thank you so much for your participation. I'm going to pass it over to Colleen Curtis. Go ahead, Colleen. Colleen, you're muted if you didn't know. Okay. You're still muted, Colleen.
Okay, can you hear me now? Perfect. So, back up here, here, okay. Thank you, Mike. Ja, today, she Colleen Curtis in she, my deshkijni shlendo twitch bashishi, and Latin dashanada do deshchini dashache. Good morning, everyone. My name is Colleen Curtis. I am a member of the Navajo Nation, originally from Window Rock, Arizona. I am currently a manager within the audit and consulting group here at REDW. So today we will be providing some updates as they relate to the CARES Act, realizing that CARES is a very, very broad topic and a lot of information that's out there. So as the CFOs, controllers, and treasurers of your tribes, we have listed various other CARES Act issues you need to be aware of. So just to go down the list here, we will discuss employee retention tax credits for those businesses that did not receive a PPP loan, the Voluntary Families First Coronavirus Response Act leave provisions that was mandatory under the Act, but expired on December 31st of 2020. Implications for indirect cost, various revisions to the uniform guidance, and some audit considerations and extensions applicable to tribes. So we'll cover the impacts of these on tribal governments and their entities over the next few slides. So the employee retention tax credit, tribal governments and tribal entities are now eligible for the employee retention credit if they meet the requirements for the credit. The latest update was issued on November 16th of 2020. So both tribal governments and their business activities are considered eligible for these credits, which are provided to assist entities with keeping employees on the payroll and or covering their health insurance benefits. So for tax credits for employees on the EFMLA or COVID-19 pay, tiers 1 and 2 are those tax credits that are applicable to both government and businesses under the same EIN number. So a couple of criteria here, tribal governments and businesses, eligible employers are those businesses with operations that have been partially or fully suspended due to governmental orders due to COVID-19. So most tribal councils passed resolutions or orders to close their operations and businesses. These resolutions would meet the criteria as orders from an appropriate governmental authority. Secondly, effective January 1st of 2021, an employer is eligible for the credits if the employer's gross receipts are less than 80% of gross receipts from the same calendar quarter in 2019. So this was previously less than 50% of gross receipts. So that percentage threshold has increased. So to continue with the employee retention tax credit, through December 31st, 2020, the ERTC was available on qualified wages and health benefits per calendar quarter through from March 13th of 2020. So for employers who had more than 100 employees in the aggregate, the ERTC applied to wages paid to employees who were not working. So this included employees who were on paid administrative leave, or those the tribe continued to pay even though they were not working. So if the tribe had less than 100 employees in the aggregate, the ERTC applied to all wages, whether the employee was working or not. From January 1st of 2021 to June 30th, 2021, the aggregate 100 employee count goes up to 500. So, and wages include qualified health plan expenses incurred by the employer. This may be extended to the end of this year. However, that is, awaiting Congress. So tribal governments and tribal businesses may claim the refundable tax credits for qualified wages paid to employees. For example, if there is a tribal trade or business under a tribal government's EIN, they can take the credits for those trade or businesses for those employees only, so not the total payroll retention for the government programs. So for those of you who have completed your quarterly 941s in 2020 or for 2020, the form was revised to accommodate these changes. And one thing that we would like to note is that the tribes can benefit sooner from these credits by reducing their federal employment tax deposits. So if your payroll is outsourced, most payroll companies are applying these credits at the time that your payroll is processed. The key takeaway on this slide is that generally, if the tribe has various entities who also have separate EINs under the common control of the same tribal council, you add the counts of all of those tribal entities together to determine the 100 employees, that was for 2020, or 500 employees for 2021, to determine the eligible qualified wages and health benefits that you are eligible to claim. A few key takeaways. This is voluntary FFCRA leave provisions. So a few key takeaways on FFCRA is that mandatory paid leave under the Act ended December 31st of 2020, and employers can voluntarily extend leave through March 31st of this year. So to those who did not exhaust their leave in 2020, so a payroll tax credit is applicable only if the payroll is funded with non-PPP money. So any additional time off outside of the FFCRA is ineligible for the payroll tax credit. Again, we want to stress here that there is no double dipping. So leave provisions are a key component of the COVID safe work environment. So as an employer, this is an opportunity to offer voluntary leave to all employees under the same framework as FFCRA in order to limit employees from coming to work sick. So make sure you track any voluntary leave through March 31st of 2021. In terms of the federal contract considerations, ensure sick leave is utilized for any type of issue. So with FFCRA expiring and the uncertainty about extension, consider the use of vacation and sick leave to allow employees to get tested for exposure, outside of work, at work, or they might simply be having symptoms. So as far as the 2021 paid leave provisions beyond FFCRA, consider opportunities within the workplace, review your state, county, and city requirements for employers, COVID-19 scenarios, including quarantine, illness, and vaccine reactions, and COVID-19 work-life scenarios, including family and childcare, and providing opportunities for a work-life balance. So tribes should ensure that, ensure that these leave benefits are in your policies to meet the internal control requirements and using funding from the Coronavirus Relief Fund. So as we all know, the tribal CRF extension was granted to December 31st of 2021. So tribes can use this money to pay employees, ensure, again, no double dipping as it relates to the payroll tax credit. And tribes should charge CRF for COVID-related expenditures to free up federal funds for other projects. So ensure you have reliable and accurate tracking methods for the leave, including account codes, earning codes things that you might, if you have not set those up already in your systems. So the next couple of slides will speak to indirect cost and the treatment of CARES Act funds as it relates to the preparation of your indirect cost proposals. So can the CRF be charged for indirect cost according to the entity's indirect cost rate? And the answer is no. So the federal guidelines state that CARES Act funding does not allow for a tribe's indirect cost rate to be applied and charged. However, if you have direct administrative costs incurred to administer the CRF, those may be charged. And, some of these expenses might include administrative, management salaries and accounting that are directly supporting CARES Act expenses. So as an example, a tribal entity has a fiscal year end of 9/30/20 and COVID-related expenditures. The tribal entity will need to record the actual amount spent on COVID expenditures through fiscal year end 9/30/20 in its direct cost base. So any unspent or unused funds will be included in the following year's proposed base. Tribal entities will need to reconcile the money spent on COVID-related expenditures through their fiscal year end so they can properly classify these costs as an exclusion or inclusion in the base. So it's no different than any other federal funding source. The only difference is that there is no indirect provided. In terms of the CFA preparation, CARES Act dollars will need to be listed separately. And the federal guidelines state that CARES Act funding, again, does not allow for indirect cost rate to be applied to it. So there should not be any deduction for indirect on those funds. So here again, we just want to stress the importance of reconciling your expenditures related to COVID as you prepare your and get ready to prepare for your indirect cost proposal submissions. So in the next few slides, we're going to talk and highlight a few of the revisions to the uniform guidance as they pertain to tribal entities. Revisions in the final guidance became effective on November 12th of 2020. In the revision, pass-through entities are responsible for addressing only a sub-recipient's audit findings that are specifically related to their subaward and not all of the sub-recipient's audit findings. So from the perspective of the pass-through entity, monitoring is going to be very important here. And some of those responsibilities will be imperative, to ensure these audit findings are resolved. So some things you might want to consider as far as monitoring and or quarterly review of grant expenditures, including CARES Act, until these funds are fully spent. Ensure the subrecipient is prepared for the annual single audit or program-specific audit if that is deemed necessary, and these are for expenditures in excess of $750,000. Follow up on any single audit findings that are specific to their subaward, and last, holding a grant call with subrecipient, the subrecipient prior to disbursement of funds to cover any compliance requirements and monitoring plans. The second point here is closeout provisions were revised from 90 days to 120 days to allow for timely closeout of awards. Also to improve the accuracy of reporting and kind of reduce the recipient burden. So just be aware that although the recipient benefits from a longer closeout period, it does come with some compliance risk. So meaning that OMB will now require the granting agencies to report non-compliance if the final closeout reports are not filed within the 120-day period. So some additional revisions here. The micro purchase threshold and the simplified acquisition threshold increases reflect the changes implemented by the National Defense Authorization Act of 2018. So the changes include the increases in the micro purchase threshold from $3,500 to $10,000 and the simplified acquisition threshold from $100,000 to $250,000. So, and in regards to the de minimis rate, under the existing regulations, only non-federal entities that have never received a negotiated indirect cost rate would elect or could elect to charge a minimum of 10%. Unfortunately, expanded use of the indirect de minimis rate does not apply to Indian tribes. So the final guidance adds a new section at 2 CFR 200.322, which is domestic preferences for procurement, which encourages federal awarding agencies to maximize the use of goods, products, and materials produced in the United States when purchasing goods and services under federal awards. So at the same time, tribes are to ensure they do not purchase telecom and video related equipment from certain Chinese companies or for goods from any other country considered a US enemy. So some other considerations are include the Davis-Bacon, local education agencies and hazard pay. So for CRF, Davis-Bacon does not apply to construction contracts. The CRF funds and FEMA funds do not include any Davis-Bacon wage requirements. For LEAs, tribes may provide up to $500 per student to schools without additional support. Auditors will assess here internal controls over the process and ensure, again, that there is no double dipping. In terms of hazard pay, that is allowable per the CRF limitations, and tribes should have a clear risk-based approach with appropriate policies implemented. So you'll need to define, who your eligible employees are, the COVID-19 exposure risks and reasonable amounts. So hazard pay does have to meet 2 criteria, which is the pay is for performing a hazardous duty, and the hazardous duty is related to COVID-19. So and Mike pointed out these a little bit earlier, but just to note a few areas your auditor will be testing for the CRF program, again, is the allowable activities and allowable costs based on the Treasury guidance and FAQs. The period of performance is March 1st to December 31st of 2021, and that the quarterly financial progress reports are timely filed. And last but not least, there are provisions in the bill that may changes to certain federal programs established by the CARES Act. For example, the spend deadline for coronavirus, the CRF, has been extended to the end of this year. And so per the supplement addendum, the extension does not require individual recipients and subrecipients seek approval. There should always be an effort to meet the initial timeline, but if you do meet the eligibility criteria for the extension, it is automatic. So you don't need to approach a federal agency to obtain approval. However, just make sure that you document the reason for the delayed filing. And just one other thing to know, with the Federal Audit Clearinghouse will not acknowledge that an entity was eligible to take the extension. The FAC will date the submissions just as they always have in their system. So again, just make sure that you maintain good documentation for this reason. So I am going to hand it over now to Marcus Spinelli, who is going to talk further about the COVID-19 Provider Relief Fund. Thank you.
Great, thanks, Colleen. Yat eshk edosh ne she Marcus Spinelli neshe nanisht eja de ne neshle na kaida ne bashishchin kiani dashiche but ani dashinale akut ego de ne neshle. Good morning, everybody. My name is Marcus Spinelli. I'm an enrolled member of the Navajo Nation. Also a senior audit associate with the Audit and Consulting Department. And today I'll be discussing the topic on the COVID-19 Provider Relief Fund. After the course of this topic, you'll be able to understand the elements of the Provider Relief Fund, be able to identify both expense methodologies and lost revenue calculations, as well as be able to review the audit and compliance requirements for the Provider Relief Fund. So first off, what is the Provider Relief Fund? This funding is for healthcare providers to prevent, prepare for, and respond to coronavirus. It can be used for building or construction of temporary structures, leasing of properties, medical supplies and equipment, including personal protective equipment and testing supplies, increased workforce and trainings, emergency operation centers, retrofitting facilities, and surge capacity in the fight against the COVID-19. So on this slide, we wanted to highlight that there are two aspects that fall under the Provider Relief Fund, general and targeted. There were 3 phased distributions of funding under the CARES Act, including a targeted distribution to tribes and the Indian Health Service. In May of 2020, $500 million was allocated to around 438 tribal hospitals, clinics, and urban health centers. Now, keep in mind that a majority of those payments were sent to providers without application, with requirements for recipients to accept the terms and conditions through an online portal or return the funds. The CFDA numbers were not provided at the time of payment, nor included in the initial terms and conditions. So here we wanted to highlight that information. The Provider Relief Fund is administered by the DHHS, qualified providers of governmental, non-for-profit, and for-profit healthcare providers received Provider Relief Fund payments for healthcare-related expenses or lost revenue due to COVID-19. These distributions did not need to be repaid to the U.S. government, assuming the providers comply with the terms and conditions. As you may recall in a previous slide, the majority of payments were sent out to providers without application. Essentially, recipients were required to either accept the terms and conditions or return the funds. These next few slides are key items from the Indian Health Service targeted distribution terms and conditions. Firstly, the recipient must certify that the tribal healthcare entity has been providing COVID-related services to patients after January 31st. Additionally, the recipient must not be terminated from participation in any of the national payer programs, such as Medicare or Medicaid, and billing privileges are still in good standing. Another big highlight is that the funding requires the provider to consent to DHHS publicly disclosing the payment a provider receives from the relief fund and acknowledge that such disclosure may allow some third parties to estimate gross receipts or sales, program service revenue, or other equivalent information. Recipients must maintain records and cost documentation as described in 45 CFR section 75.302. Here, the financial management requires records are sufficient to permit the preparation of reports required by general and program-specific terms and conditions. This means that the tracing of funds to a level of expenditures are adequate to establish that such funds have been used in accordance to federal statutes, regulations, and terms and conditions of the federal award. Now, the unique thing to keep in mind about the Provider Relief Fund is that the money can be used for COVID-related expenses or for lost revenue. The biggest highlight of this slide is that a certification that you cannot double dip, meaning you can't use expenses that you used as a qualification for another source. This requires tribal healthcare entities to carefully consider and allocate expenses per the various CARES Act funding requirements that you received and ensure you haven't duplicated covering the same expenses with different funding streams. The full IHS targeted distribution terms and conditions are available here on this cited website. So next, I'm going to launch or ask Carla if she could launch the next polling question. And again, if you guys want CPE credit, please respond.
I think the answers are starting to slow down.
Okay.
So I'll give it 5 seconds. All right, I'm going to end the poll and
Great.
share the results.
Thank you. Okay, so this question was really just more geared towards a survey of the audience to kind of gain an understanding of what compliance requirements does your organization find most challenging. And based on the popular vote is just sounds like C, ensuring that support is in compliance with provider relief funds. So let's get a little more into this. Okay, so now let's discuss the activities allowed under Provider Relief Fund. This definition is left intentionally broad by DHHS to include products, services, or repayments meant to prevent, prepare for, and respond to COVID-19. Now, some of the examples include supplies such as personal protective equipment or other testing safety gear, equipment like tents or other purchases necessary to test and care for patients, personnel working triage, etc. Please note that this is for all distributions except the skilled nursing distribution. The highlight of this slide is to show that the provider relief money can be used for COVID-related expenses, lost revenue, or a combination of both. DHHS require that the recipients ensure sufficient documentation on meeting the terms and conditions. Again, please note that all distributions are applicable except the skilled nursing distribution, and that has its own separate information. If you guys would like additional information, if you are a skilled nursing distribution, we can provide that information. Just send us a link and we can get that for you. Here, the biggest thing is, noting the last sentence, no double dipping. So in considering all your healthcare entities, allocating your costs, and use the most restrictive guidelines for costs within the required timeframes. And this is applicable for all of the distributions. So let's talk a little bit about lost revenue calculations. So some things to keep in mind related to the lost revenue calculations. Recipients need to maintain detailed documentation outlining their methods used in the calculation and rationale behind these methods. Financial records should show prior year and 2020 income statement details evidencing net operating revenue from patient care. Board approved financials for both 2019 and 2020, as well as documentation of the timeline of comparison. Keep in mind that some recipients may have to go beyond 12/31/2020 in their assessment of lost revenues. Further guidance on lost revenue calculation for 2021 is still pending. We're waiting guidance. All recipients must report within 45 days of the end of calendar year 2020 on their expenditures through the period ending 12/31/2020. Recipients who have expended funds in full prior to December 31, 2020 may submit a single final report at any time during the window that began January 15th, but no later than February 15th of 2021. Recipients with funds unexpended after December 31, 2020 must submit a second and final report no later than July 31st, 2021. Now, some considerations for accounting. Governmental entities will use GASB 33 as their framework for recognition, as the provider relief fund is not earned with services. Therefore, it should be treated as a non-exchange transaction. Not-for-profit entities should apply ASC 958605 to the government grants they receive, including the COVID-related awards. Now, most COVID-related awards will be characterized as a non-exchange transaction or contributions received, essentially, because the purpose of the award is to provide relief to the recipients of the award and not for the direct benefit of the awarding agency. So classification of these contributions received depends on whether the transactions are a part of the entity's ongoing major or central activities or peripheral or incidental activities. We expect that non-for-profits will classify the COVID-related funds as other operating revenue. Now, here we highlight the biggest difference for single audit and CFR reporting. Per the specific guidance from DHHS and the 2020 OMB Compliance Supplement, as well as the addendum, essentially you will account for what you report to DHHS on the Provider Relief Fund for the total amount expended and anything left over or not spent, as long as you meet the requirement based on what you reported to DHHS. And the balance should be recognized as lost revenues. It's very critical to maintain the support of what you report for purposes of the single audit and CFA that agrees to what you reported to DHHS for the Provider Relief Fund, and add that disclosure to your CFA footnotes. Here, another new CFA disclosure is PP&E, personal protective equipment. Making sure that we include a footnote with the amount of donated PPE, which this essentially is information related to audit due dates and treatment of donated PP&E can be found on Part 8, Appendix 7 of the Addendum on the Compliance Supplement. Fiscal years ending after 12/31/2020 disclose that these CFA amounts are based on the 12/31/2020 Provider Relief Fund report. Okay, so now I understand that today I've provided a lot of information over the COVID-19 Provider Relief Fund, but I wanted to ensure that you all have access to these resources that can provide more background, guidance, and answer some frequently asked questions on the Provider Relief Fund, which you may potentially have after this webinar. I'd like to thank you for your time, and I'll hand it back to Carla to wrap us up.
Very good, Marcus. Well, thank you everyone for joining us today. We're only 1 minute over time. Maybe Corinne, do you have some final words before I end with housekeeping?
No, but just wish everyone well and be sure to reach out to us if you have any questions. There's a lot of information here today that we just wanted to give you an overview of. So please feel free to reach out to any one of us as you work through your own facts and circumstances of what you're dealing with. Take care.
Great. Thanks. Okay, remember, for those of you interested in CPE credit, as soon as this webinar ends, watch for an online form to pop up on your screen. You'll just need to fill that out and submit it to request that credit. Then at about this time tomorrow, you'll get a follow-up email. It'll contain a link to a web page that will contain the recording of this webinar, a copy of the slides, a whole bunch of hyperlinks that our various presenters have provided. And we'll give you the 2 questions that people asked online. We'll have that Q&A included as well. So please enjoy the rest of your day and stay safe, everybody. Bye-bye.